we'll be starting at 10 o'clock. So it looks like it's 10 on the dot here. So today's speaker is Jack Davis. And Jack, I'll go ahead and ask you to share your screen and I'll let you take over.
Okay, we're here.
All right, so, sounds great.
Yep. Okay. Good morning, everyone. And we're going to start out. I'm going to answer a question that came in from last week on corn, and then talk a little bit about Farm Bill sign up, and then we'll touch on our soybean markets. So last week we got asked on China's corn stocks, and I've converted this to million bushel. So they have dropped from their peak of about 8.8 billion bushel ending stocks in 16 and 17 to right about 7.5 billion bushel. So a pretty good drop, but I just checked as far as the world is concerned, they've stayed about at 60% of the world's ending stocks for corn. We'll show one more thing on that. May help explain their demand for imports. They've come off of some of the African swine flu incidences and rebuilding their hog herd. And as we can see, their feed consumption has continued to grow throughout and maybe past what they want as their ending stocks. And there was news today that there is another strain of the African swine fever out, so we'll see how that will play out in the market. So we'll look at Farm Bill. We have a new sign up coming, and the deadline is 3/15, so that'll sneak up on us same time as our crop insurance sign up deadline or closing date. And it's only for 2021 year, and that'll be each year of the remaining Farm Bill. The support prices or PLC prices are listed there. Corn at 370, soybeans at 840, wheat at 550. So our program choice will be really probably between the ARC County and PLC. And for corn and wheat, it kind of tends to lean toward possibly PLC if you want just that price protection. Probably favors wheat a little more than corn. In the past, we haven't fallen below much of that 370 or not for very long for a market year average price in corn. And wheat has been below the 550, but may not be for our 21 year. Now these payments will come in October of 22, so a year later than this year. So basically on corn and wheat, you need to decide if you want some revenue protection, which our county provides, or just the price protection where it pays on your PLC yield below when prices fall below those amounts. Soybeans, the PLC reference price is pretty low, so our county is probably the most attractive choice there. And we'll have some examples using Brookings County for corn. And I just use their default. This tool is from FarmDoc, and they have a what if tool for the sign up. So I just use Brookings County. I use their default PLC yield of 161, and then a county yield of estimated at 210, and a market year average price of $4 for the 21 year. So at that level, there would be no payment on either program. Switching it up a little bit, I left the yield the same. I took a market year average price down to 356, which it was where it was the last time that PLC paid out. And using these numbers, an example, the PLC payment would be $19 per base acre. If our market year average price ended up at $4, there would not be a PLC payment, of course, just as it showed in the last slide. And looking at Ark County, the revenue protection is down to $6.67 an acre. And if we had a $4 market year average price, corn yield would have to drop below $1.67 before Ark County would pay. In this example, I just wanted to make them where they were about even between PLC and Ark County. So we held that price at $3.56. We'd get a $19 per base acre PLC payment, and the county yield would have to fall to $1.81, and the Ark County would pay it at $20. So approximately $1.81, and they would be equal. Let's see. Here I took worst case scenario, poor yield in South Dakota or Brookings County and a low price, meaning the rest of the nation had great yields probably, and just showing how Ark County would provide more protection if you really have that revenue disaster. So just some examples, and we have a little while before sign up is due, so we can kind of watch what prices do going forward and make our decision. And then again, we're not signing up for more than 1 year. It's a 1 year at a time from here on out on the Farm Bill. So take a look at soybeans. Our yield going off our January report, or the final production report, was down half a bushel from a December estimate. So final yield estimated at 50.22 bushel per acre. Here's just showing the change and the percent change from the previous years. So that yield reduction took our total production down to not quite 1% versus December. It decreased our final production 35 million bushel from that December estimate. This is production estimates, what the industry thought, and then what NASS reported on those report dates for each month. And those report dates are anywhere from the 8th to the 12th of those months. So as we can see, early on in August, NASS was expecting a lot bigger yield and more production than the trade was. And then in September, NASS estimate was about in the middle of where the industry was, about the same for October. And then let's see if November, NASS was way lower than all of the industry expectations. In the final, about even, a little bit on the lower side for NASS than industry expected. Exports for the current year, marketing year, which starts September 1st through December, were up 78% this year. So the soybean, the total for the year was increased exports by 30 million bushel. And for all of the increase, China has taken all of that. So all of the soybean export increase has gone to China. Our soybean ending stocks are down 68% from August. So we talk about this quick turnaround, and And as prices started to go up, many of us probably sold a little bit early, or wishing we had some soybeans left probably. But we just, we really didn't know that it was going to be that harsh. I think that August weather took a lot more out than NAS was expecting and estimates were expecting. From 2019 to 2020, looking at our 19-year, we have a 75% reduction in ending stocks to use. And this is really what's driving our price. It's our ending stocks divided by the total usage for the year. And as we can see here, that is down the lowest it's been since 14 and really 13. When prices were actually quite a bit higher. So quite a drop year over year. We've really switched the market fundamentals from last year. And if we have problems in the US or world with soybean production, prices will react much more than they would when we're back here at a 13 or 23% ending stocks to use. So we're in a low stocks to use situation going into this year. So our old crop and our new crop will be more susceptible to any stresses on the growing of the new crop. Well, you can see USDA raised market year average price to 11.15. That's still not as high as what we ended up back here in 13 and 14. So possibly some room to go up. But even though, with that being said, these levels of price are probably profitable, and it may be advisable to go ahead and market some coming up. If you have some that you've hung on to, well, you can sell them now for more profit than what you have in storage, or hang on and take a little more risk going forward into the spring. Just a world stocks to use point. So using that same ratio, the ending stocks to world use, and we can see that we're down quite a bit from a peak a few years ago, both on the corn and the soybeans. We're back into that level worldwide, at least on soybeans, where we were in that 11 through 13 time frame. I'm going to show a few charts here of the soybean futures. This is the monthly nearby, and I went for 10 years. So it takes the nearest monthly contract, and those are the bars here is our monthlies. So each month it'll switch to the new to the closest contract. So it gives us a good continuation and maybe some price points to pick from. And I just arbitrarily drew these lines across here. I just picked right at a close that was in the middle here back in probably August of 12, and drew a line across, which is right at 1138. Then I went up into kind of the top here, a little bit of the middle, and just like I said, I arbitrarily drew that across. That one came in at 1387, I believe it is. And I thought, well, let's pick one off of the bottom of these very peaks, and that is at 1528. Now we've had some good production news, and maybe the African swine fever, maybe a little dollar higher, things affecting the market today. Also, we've had quite a bit of run up, and funds are willing to take some profit. And on the on our March contract, we'd still hope to see a close above 310 or 320. I'm not quite sure where it's at right now. Did I say 3? I meant 13, 1320 or 1310. We want to see it close above that area, or not fall much below that, and help hold that support. Really, if funds get out, it'll give a chance for commercials and users to get back in. So this little dip or correction probably doesn't hurt anything. I know it does if you were getting ready to sell and now you're down 20, 30 cents, then it hurts. But for the market as a whole, probably a good little correction if we can hold those supports. So switching here to the July contract, and I went with just a daily here. So if you're looking at a specific contract that you're looking at marketing, you'll want to switch to a daily chart. And I went out one year. And the study that I have overlaid is a Bollinger Band study. And what that does is take a moving average and then go the upper band and lower band are standard deviations off of that. And in this one, I used 143-day moving average and 2.5 standard deviations off of that moving average. And Dr. Elliott, Matt Elliott, and Lisa Elliott did some studying on this using our trading lab, and they back tested it. And this was kind of they picked this number for a moving average and standard deviation, so you don't get as many sell signals. I had my internet is going slow on me here. Sorry about that. And I'm using bar chart. So bar chart standard is a 20-day moving average and 2 standard deviations. I just widened that out to get maybe a smoother line and not quite as many sell signals. So when you go up above these upper bands, it would be a sell signal. And if that, along with the necessary trend and volume, would indicate that it may be time to sell some. So as we can see here, we broke through earlier this week, and now we've fallen below that. So it was probably a good signal to sell earlier this week. If we've missed that, we can kind of wait, see what happens today, and look what our situation is going forward. I just wanted to show you these and what it looks like here for the July futures. Now looking at December's, I used the same moving average and the same standard deviation for the Bollinger Bands. We again got that signal to sell earlier in the week. And one of the things that I like to see producers do is to spread that out. It's not an all or nothing thing. We can spread those sales out, and I think guys are pretty good about doing that. And then ramp them up. So if we would have had a signal back in here to sell, maybe we sell say 10%. If we want to divide it out that way, as our price targets go up, we can sell a higher percentage or even split it equally. But ramp the sales up as price go up and set those different targets. Another thing I like to see you guys do is go ahead and value their crop, say each week or at least each month. Not only that crop that you have in storage, but also that is growing, through a yield estimate and a price that you could forward contract or futures price. going forward on new crop growing stuff. That really helps in enforcing your marketing plan when you put a value on your total crop, say each week or each month. So we have a looking at operating profit margin. I showed some slides using corn or the 2,000 to 5,000 acre farms. This is taken from FinBin, which is a database housed at the University of Minnesota. And what it is farmers that belong to management groups and record keeping groups in South Dakota, North Dakota, Nebraska, and Minnesota. And I just picked their operating profit margin for this level of crop farm of 2,000 to 5,000 acres in those states. So we can see we've had quite a run below average, and we have some opportunities with current prices to be above the average that we have over the last 12 years or so. I just wanted to share that. There are opportunities for profit, but I think we got to know where our costs in and lock in if they're favorable and take advantage of some price risk opportunities. Like I said, our stocks to use are in a lower range, so weather will have a bigger impact as we go into our growing season. And we'll see, we should have a decent insurance coverage with these price levels, better than we have the last 3 to 4 years. So that should be good as we get through February and set that crop insurance price. The unknowns, we have a long ways to go till we have a new crop. So there'll be a lot of unknowns that and our return to normal as we work through the virus and other situations. I'll leave you with this, is the same as I did last week. Knowing your numbers is always a good thing to do. Take advantage of price risk protection, reduce direct costs where you can. And I've used that 80-20 rule. So if we are using that, that'd be top 4 or 5 line items. See what you can do to get the most out of those items. I don't think just blindly cut them, but make sure you're doing your best job of management, and that's where you want to concentrate. That is on those 4 or 5 top things. And of course, for corn, definitely it's seed and fertilizer would be one of the top 2, and then we're probably getting into machinery costs, which is a little tougher to manage, but you got to know that and keep track of that. And then rent, of course, is also a high one that falls in there. And I would not look for rents to necessarily ease. You know, we've had a lot of government support, supposedly, or that makes the news. And people hear that, and just not a mode for reducing of cash rent. So guys got to know what those pieces of property are doing for you and how it would affect you if one has gotten out of line or needs to be dropped, and what that might do for the rest of your farm. I think guys have done a great job of managing capital purchases. We may be in a situation where we need to update some of that, but take a hard look and see what your cheapest method to do that and doing it efficiently and well. That's what I have for today. I probably ended up a little bit short, but if we got any questions, we can sure take those.
Yep, if anybody has questions, please feel free to type those into the Q&A portion. And as I mentioned, we will be having a short poll. And I will be, Jack, if you want to stop sharing, I'll put up the CCA credits. Thanks, Jack. All right, so the CCA credits are up, and I see people are answering the poll, so thank you. We'll leave that up for just a couple more minutes for the poll, and I'll leave the CCA credits up for a couple minutes as well. Jack, it looks like we have our first question in. Funds are very long. Have you seen much selling there?
Yes, and we get our commitment of traders report. But that's always a week late. I think they are the ones probably selling off as we came to the end of this week. Some of those sell signals were there, and by stuff that I listen to and read or hear, that's okay for them to reduce a little bit of their long. Fundamentally, we're very, very strong yet, and we've had a good run up. Not a bad time for them to take some profit, and lower prices let our end users get in and really fuel that demand some more. That's my feeling.
All right, and if you have any other questions for Jack, please feel free to type them in, or if you'd like to wait, we will be in just a few minutes transitioning over to that Q&A session here at the end, so you're free to ask either way. All right, well, I think we can end our poll here. And just while we wait here for a minute, Jack, it looks like you have one more question just popped up. The question is, I would expect more sales, but since they haven't, they feel the market is going to go up. What is the latest on South America?
Well, this last week or the beginning of the week, they did receive some decent rain across there and looking a little better. And I think they raised their soybean crop, but we're still a little bit off from then being able to ship or go with their crop as they get into harvest. So we'll just have to see.
All right. And just a reminder to everyone, we will be having a session for the crop hour next week. Next week, we will be covering wheat. So on Tuesday, Paul Johnson and Garrett Schaefer will be talking about weeds and weed management. The 27th, I will be speaking on insect pest updates on wheat, as well as some relatives of insects that we ran into during 2020. I don't know if we'll have to worry about them as much, but we'll talk about that more next week. And on the 27th, Dr. Emmanuel Biamakama will also be speaking on diseases of wheat. On the 28th, we'll have Anthony Bly presenting on wheat soil fertility, and then Dr. Jonathan Kleinjohn presenting on choosing the best wheat variety. And then if you join us on next Friday, the 29th, Jack Davis will be talking to us again. Jack, you'll be presenting on wheat marketing. So I see that we do have another question. Are there any beginning marketing classes being worked on?
We don't have anything in the works right now. We don't.
Okay.
Through Extension. If you're interested in that, I would ask that probably a group contact me, and then we'd work on what you guys might want to look at. That's probably the best way to handle that.
All right. All right. I believe, Matt, we can transition now. Thank you, everybody, for joining us. We're going to transition now to the Q&A session.